Hello, everyone. I'm Ted Oakley, managing partner at Oxbow. And today we have one of my very, very favorite people to talk to, Danielle DiMartino Booth, who is CEO and Chief Strategist for QI Research. And Danielle has done everything I can think of, from writing books to her great services, which I would recommend to all of you to take a look at. And Danielle, I've told you before, but you're one of the best writers. I don't know how you do it. One of the best writers I've ever seen.
Well, Ted, thank you. The writing portion is not the easiest, but every single time I write, I learn something. And I think the real key to being progressing as a human being is being humble to the fact that you can never stop learning. I never knew that John Maynard Keynes was the first one to dream up a cryptocurrency as an alternative to the US dollar because he wanted to take it down before it even achieved hegemony. But I learned that last week. So you learn something new every
Oh,
time.
I didn't know that either, other than the fact that I read you all the time. But I wanted to say you've had some great information the last 3 or 4 months that should make people stop and think. I know the street not necessarily agreeing with you, but I'm going to let you take it from here because I think you have some great things to talk about.
So a few weeks ago, I was woken to news. Danielle, Bloomberg Economics agrees with you. And I said, which part? And they said, well, no, they agree that recession is going to be backdated to at least October of 2023. And I doubt that anybody in mainstream financial media would use the term gaslighting. But the more I travel, the more I'm in Indiana, in the heartland of factory USA, and hear of the plants closing, and the more I speak to the class of 2024 college graduates, the more the term gaslighting resonates with me and has resonated with me because they keep saying, I don't care what I'm being told. This is not a strong job market. It's the jobs just aren't there. And if they are there, I have a computer science degree. 4 years ago, I was told that I would have a great job coming out of a great school. And I'm contemplating a $20 an hour position at a help desk because you know what? AI has made this person's job that was a very well paying job 4 years ago redundant. And so the reality is, most of the street is not going to acknowledge the census's quarterly requirement to 20 million US employers that they report the number of employees they have. But the fact is that it is a requirement by law, and every quarter with a long lag, we receive data really that squares up what the Bureau of Labor Statistics reports on non-farm payroll Friday. And the one that really struck me, given the McKelvey rule is just as efficacious as the Somm rule. We ran the numbers last year. It looked like it was triggered in October of 2023. It was re-triggered again this April, but the minute it was triggered, the unemployment rate had risen 0.3 percentage points off of its 12-month low on a 3-month moving average basis. I hope your eyes didn't just roll back to the back of your head, but since 1968, we've always been in recession when the McKelvey rule was triggered. And we found out with the most recent quarterly census of employers and wages that it looked like, instead of 640,000 jobs created in the quarter ended September the 30th, that they had actually lost, the economy had shed 192,000 jobs on a net basis. All I need to know. And I moved on.
Well, Danielle, you might mention to people, there's a few people I know, but that don't know the McKelvey and the Somm rule. You might just briefly tell
Mm-hmm.
them what that is.
So the McKelvey rule came to me verbatim from Ed McKelvey years ago. He was the chief economist at Goldman Sachs. At the time, there was this gentleman by the name of Bill Dudley who was working for him. He went on to run the markets desk at the New York Fed and then subsequently become its president. Ed had just hired a young whippersnapper by the name of Jan Hatzius. I got to work with Jan years ago on mortgage equity withdrawal, but he was the chief economist at Goldman Sachs at a very formative time, and he had formulated a rule looking back at Bureau of Labor Statistics data, and his demonstrated that if you saw the unemployment rate rise by 0.3 percentage points off of its 12-month low on a 3-month moving average basis, such that it had to hold that level of weakening the unemployment rate, that we were in the soup. The Wall Street Journal interviewed Ed in January of 2008, and that was shortly after his rule had been triggered. And in good sell-side fashion, upon being queried, well, it looks like your rule was triggered just last month in December of 2007. He said, well, maybe it might be broken. It could be different this time. So he gave a very couched answer. For whatever reason, the McKelvey rule is not followed as much as Claudia Samm's Samm rule, which requires that the unemployment rate has to be a 0.5 percentage point above its 3-month moving average over the last 12 months low point. The Samm rule actually has yet to be triggered, which is neither here nor there, because it's just as its track record is stated differently, excuse me, the McKelvey track record has yet to be broken. So if it's a lower bar, but it's also foolproof and has a perfect track record, I'm just fine to go with it.
And speaking about gaslighting, that's when you get all the 2 or 3 months later, we get the revisions that put it in the real world, right?
And that is the exact point. You know, if there's one thing I think the average US household has really tired of, it began with inflation as a figment of your collective imagination. And it has since moved on to, we're telling you that the job market is strong. Why are you not taking our words at face value? And if the dynamic has shifted a little bit, Ted, in the last few months, it's that households' anticipation that inflation is going to continue rising, that's not as bad as what it's been. That really has slowed down. But if you ask a household if their paycheck is going to keep up with inflation, now that's a whole different story. And it reflects the second chapter of this recession book, if you will, because prices are going to remain at a much higher level than they were prior to the pandemic. And you know what? By the way, my paycheck's shrinking, or my household income is shrinking. In fact, we had, on a 3-month moving average basis in the University of Michigan data, we had the steepest decline, the second steepest decline on record over a 3-month period for households' expectations for their income. So whether or not the current administration or policymakers at the Federal Reserve want to acknowledge what's happening among US households, they're definitely telling us they're hurting.
Yeah. Well, and the other side of it, I just read in the Financial Times this morning that all-time record this time of a 14% increase for CEOs of public companies. Average worker got 4%. And the tune keeps on playing, which I hate to be on a soapbox, but you know, these stacked boards that we have, can't see the forest for the trees.
Well, and that you know, Ted, that speaks to something that nobody can put on any graph in the world. But but the disparity between the haves and the have-nots is a very, very real thing. And if we don't recognize what's happening in other countries around the world that have rejected high youth unemployment rates, persistently high levels of inflation, how that's being expressed in polls is a very tangible economic phenomena that, in my view, cannot be disregarded out of hand, given we've got an election ourselves that's so close.
Yeah, that's true. That's a great slide you have there on both the McKelvey and Samm, for sure.
Yeah, Ted, I'm sorry, but we're in recession. We have been since last fall. And the question we really should be contemplating is, what is next? And, you know, given what's happening with banks, I don't see a light at the end of the tunnel yet, unless it's that train.
Yeah. Well, and that's another thing that people don't realize on the outside. They don't really realize the trouble we have in the banking system today. And you've covered a lot of, you've written some really great stuff about that the last month. but it's worse than people think, really.
So I have gotten to be friendly with a gentleman by the name of Bill Moreland, and he founded a company years ago called Bank Reg Data. And what he does on a quarterly basis is scrub from bank call sheets all the information that they have on non-performing loans, delinquency rates, and especially charge-offs. And in speaking with Bill last week, what surprises him the most are two things. He's been noting that there is a certain amount of gee, it's different this time. Last time we had Bear Stearns and Lehman Brothers and very obvious forms of stress in the financial system. And we certainly don't have that this time, so it's better. And Danielle, it's not, it's actually worse. We're seeing charge-offs across the board in commercial real estate loans, whether you're talking about multifamily construction, or your other sorts of commercial, they're actually rising at a faster pace off of their low than they were heading into the great financial crisis. So, that's kind of one of your biggest takeaways. And a lot of people follow the weekly data published by the Fed, and they say, you know what, Danielle, commercial real estate loan growth still has a plus sign in front of it. And to that, Bill Moreland said he too was a bit perplexed by that. And so he started asking around, and he said it really came down to the sheer magnitude of lending that had occurred on a commitment basis. So think of it as a line of credit that the bank has out to any given company. And he said the reason we've seen commercial real estate continue to rise is simply that we've seen commitments drawn down. And there's a whole lot of nothing behind that. And those commitments have largely been exhausted. So we're kind of at a Wile E. Coyote moment for bank lending, because we're about to see it hit a huge air pocket now that these commitments have been fulfilled. There's nothing behind it.
Well, and and a lot of banks are getting up close to that 300% level. And of course, they'll do some negotiating, I should say, with the OCC because part of, sometimes you have owner operator loans and that kind of thing, but there's a lot of just straight CRE that's in trouble. And, we put it off so long that now I don't think you can kick the can down the road anymore. If that's, to me, at least anyway.
No, it's there's something fascinating about looking at the progression of what large banks have recognized as being delinquent, or a loan that is no longer accruing, or if you put it into the proper formal not performing loan category, and then you go to the absolute limit and charge off a loan. And if you're a great big giant, JP Morgan, Wells Fargo, Bank of America, you've taken some lumps. You certainly, on a percentage basis of your loan book, taken much more in the way of lumps compared to your small and regional banks who are extending and pretending. You put it much more diplomatically than I did, but they're coming to the end of the period where they can try and look the other way. In fact, regulators have been somewhat complicit in helping banks not recognize these losses. But again, the time is coming to an end. I think one of the reasons, Ted, and maybe I've watched the movie Yentl one too many times, matchmaker. But I think one of the reasons we're going to actually start to see recognitions is because we're going to have to go from singing the song matchmaker to just plain old shotgun weddings. And the reason we haven't seen the FDIC broker more marriages compared to where we were at the same time going into the great financial cycle is because the brides have had no dowries. And that's a real problem. That's a real problem if you're trying to get two banks and broker a marriage when you've got the level of unrecognized losses on treasury and mortgage-backed securities holdings that were such buzzwords when Silicon Valley Bank went away. But it's very difficult to say to Bank A, you must buy Bank B. Your bride has no dowry. In fact, you're going to have to pay off your bride's debts in order to marry her. And by the way, we can't tell her what her other debts are. when we start to look inside that commercial real estate loan portfolio. So you're buying unknown debts on top of debts that you can quantify. Difficult to broker the marriages, but it's going to have to be done.
Well, you have a great slide too, your slide on avoidance tactics right now. I think that is really true right now, that you try to do, if you talk and you listen around, they know they have things on the bubble that are not great, but they're slow or reticent to take it. And I think that's where you get into. And with rates holding up right here, the spread for banks are going to stay in trouble as you go along. And so I think that you've done some really good work in putting that together out there. And you talked a good bit about whether it's just going to stay in CRE or not, or you're going to go over to something else.
Well, so Ted, I didn't want to interrupt, but what's fascinating to me is that FactSet has pointed out that in earnings calls, that mentions of retirement really have faded, unless you're talking about financials.
Right.
And in the case of financials, that's where they're talking about recession the most. And it's because they know that they're going to be the source of a ratcheting up of the credit crisis, because they know that they're the ones who are not going to be extending loans, whether it's on the household side, automobile credit, these credit card charge-offs. Capital One just came out with their latest figures. These charge-off levels are staying at extraordinarily high levels. And so it's going to continue to hit the household sector at a time when, as we just spoke, income expectations are collapsing. So without the credit, without the income, how are they going to buy?
Well, and you also mentioned too, and I agree with this, that if you look at now, you're seeing there's been two articles in the Wall Street Journal in the last 2 weeks about the fact that pension plans and people in private real estate can't get their money out. And now they're having to take some charge downs as well. So you've got that on top of what's in the public market or the bank market. So that probably adds fuel to the fire for your recession call.
It does, Ted, and I don't find there to be a coincidence with the fact that Bloomberg put a great story out last week about the New York Federal Reserve coming under fire because, I don't know, because Danielle built up a great markets desk presence, the Dallas Fed, and now it's got more credibility. How did that happen? But Liberty Street economics out of the New York Fed, I find no coincidence in the fact that this week they're going to be putting out 3 letters in a row, Monday, Tuesday. They're going to skip the holiday, and Thursday, about how critical it is to begin to regulate the non-banks. And so I'm going to be writing about this. And a lot of it has to do with the fact that if you're a public pension plan and you are taking massive losses and you have no liquidity to speak of when you've piled into alternative investments all these years, you and I've spoken about it offline constantly. Lord help the retail investors that have been roped into trying to buy into these private and alternatives looking for higher returns, when as things turn out, the returns aren't higher, but the illiquidity is. So I go back to why Jerome Hayden Powell is going to look the other way at Danielle's recession call, because he certainly does know that I've made it. I have that on good authority. But why he's going to look the other way is because he's holding out really for Basel III to be pressed through, which will take that'll take most of the rest of his term in office, which ends in May of 2026. So, if you're being asked to contemplate the worst of two choices and you knowingly continue to have policy that's higher for longer in recession, you better have a noble reason for doing so. But if that reason is pressing forward with Basel III endgame so that you can finally start to regulate the non-banks, well, then you'll start to right the imbalances between the haves and the have-nots. And I think if we look as far out over the horizon as we possibly can, that really is why Jay Powell is pressing into month 12 of, because once we hit July, it'll be the 12th month since he stopped loosening policy. And of course, heading into the great financial crisis, the Fed waited 15 months, and we know that that was much too long.
You have a great, great slide, by the way, showing what happens. I don't think anybody's ever put it together like this. What happens when they start lowering rates for the first quarter of a point or first half a point. Really good stuff.
You know, people are individuals who have had their entire career in investing in a zero interest rate environment. They don't quite understand that the Fed, unless it's a global pandemic, unless Lehman Brothers has collapsed and unleashed systemic risk, unless you have something of that magnitude, it's never time to pull out the party hats when the Fed starts to lower interest rates. In fact, it's the opposite. And so by saying we're going to wait until the December meeting to lower interest rates, it wasn't necessarily a cause for celebration. You do tend to see a final blow off top in stocks, a good 10% rally. Once you're fully aware that the Fed's going to start lowering interest rate, but not quite yet. But I think time's going to run out, Ted, because in August, we have our next census quarterly estimate of employment and wages. When that comes out, Ted, if it's not just the third quarter of 2023, but also the third and fourth quarter of 2023 with net job losses, the fine arbiters at the Recession Dating Committee at the National Bureau of Economic Research, they're going to have a really hard time ignoring 6 months of job losses on a net basis. So I don't, bless Jerome's heart, I don't think he makes it to December. I think by then he'll have enough information in hand to know that 6 months of job losses will probably compel him to move in the September FOMC meeting.
You don't have a question, and you have some of the best slides on consumers and really what shape they're really in, particularly the one about how they're the people that shouldn't be borrowing or borrowing to travel and do certain things.
Oh, buy now, pay later to travel.
Yeah. I mean, and you're getting all of that. And just just last week, there was an article came out from Leaning Tree that 45% of the people that go to Disney World borrow the money. And so I found that interesting as well. And you've got a lot that backs that up in some of those slides. Why do you think the Fed doesn't see that, though?
I certainly do think that the Fed sees the data. They certainly hear about the data. Even if the pragmatists who read and see and hear all of this make mention of it to the PhDs on the staff, the PhDs are going to come back and say, well, we wouldn't even see buy now, pay later in any form of data. And you know what, Ted, they're right. Apple is the first organization, is the first financial that is reporting and has announced that it's going to be reporting buy now, pay later to the credit agencies. Otherwise, it's not seen. And what's most incredible, I'm going back to Bill Moreland at Bank Reg Data, is it's not the kind of the third party lenders and they're backed by who knows what out of China or anywhere you could imagine that these buy now, pay later are getting the money to make the loans. It's more so that the biggest US banks, JP Morgan Chases of the world, the Wells Fargo, the Chases, the Capital Ones, Capital One has slowed down. I take that back. But most of the largest credit card lenders, knowing that buy now, pay later was growing at a pace of the third of the growth of credit cards, kept increasing their credit card loan books. And, for the life of Bill Moreland, for the life of me, I can't understand that, because banks have knowingly continued to lend into an area that has become toxic. And so what I'm trying to tell you is that the largest banks are not going to be immune from having to take some pretty large charge-offs on their consumer loan books, because they have failed to become a little bit more reticent when it comes to credit card lending. So not good practices. And
you've got a couple of good slides on that too, by the way.
Sorry?
I said you have a couple of good slides on that too, by the way, of just that, what you just talked about. And they, and so one of the things I guess what you're saying then, Tony, if you think about what the numbers you're thinking about for August and September, when they go negative, okay, then everybody has to wake up and say, hey, we've got a problem here in Paradise. And it seems like, what I would call rich people that are in the market, they're not thinking about any of this. I think things are still great. And particularly that group you talk about that's only been around for 15 years, they tend to think that all of this will go away real easily, real quietly. And I said this before, but you had a short bear market, 5 weeks in 2020, and in 22 you had a 10-month bear market. So everybody's like, well, it won't be long, So that's I don't know how you see that, but it seems that way to us at least.
Well, and I think that part of the problem with having had a year ago, literally 12 months ago, there was maybe $25 billion being pumped into the US economy in the form of employee retention credit cash. And in July of 2023, there was $30 billion that was pumped into the US economy in cash, directly deposited into the bank accounts of mostly well-to-do individuals. So billions and billions of dollars. But we've stepped away from that, and we're not going to get back there, Ted, until April of 2025 at the earliest. That's going to be the first time that we see what we came to know as being a stimulus check after the pandemic. That's the first instance that we're really going to see blanket deposits and relief for US households. But between here and there, what we're seeing is something so strange and bizarre. The highest preponderance of individuals who can't make the rent are between 40 and 54 years old. They're not living with mom and dad. This is not the cohort that can just, pop back into the basement and pick up where they left off and just say, oh, thank heavens, I no longer have the utility bill and the rent to worry about. I just have to make sure I pay for my iPhone. And mom and dad might still be paying for that too. But I bring up this cohort because they tend to be higher income earners, and yet they're having trouble making the rent, which is just surreal. And on top of that, on November the 1st, despite the best efforts of the current administration to put that day off forever, if you make a decent amount of money and you're kind of in that older millennium, younger Generation X generation, you're having 12 months of non-payment for student loans be reported to Experian or TransUnion or whomever, because that's when the piper, so to speak, has to get paid. And November the 1st, it's not a long ways from here, and these people are already struggling to pay the rent. And that is very fresh census data. So you have to understand that there is a long time and a lot of political gridlock in the United States where we're going to see household balance sheets continue to deteriorate before anything can get done with, at the very earliest, the next income tax refund season and or the first stimulus check from either presumptive presidential nominee.
So if you were talking to the average investor out here today, I'm asking this question. From what you say and what you're looking for, economically here, I'm assuming, and from what I read from what you do as well, that you're going to be lighter on the stock market and heavier on the bond market.
That is true. In fact, I've put together a chart of what happens to returns in bonds as well as returns in stocks once you pass a critical threshold of job losses. And I would certainly say that we are there already. We've lost 1.5 million full-time jobs in the last 6 months. That's a lot of income lost. And so we are, historically speaking, we have hit that critical threshold. So you could look back at prior cycles and see exactly what you can anticipate losing between here and there, assuming a very nice, tame, short and shallow recession, which if it did start last October, that's not what's in store for us.
Well, and I think that would be most surprising thing for people because, you know, you're going to change. Well, you're going to have a new president, either a new old president or somebody's been there before. Both cases, when it comes up, and so I'm sure there'll be a lot of changes go on that, you know, also when you get into 25. But are you still okay with the long bond?
Oh, yes.
Oh, yeah, I thought you were. I just want to make sure. I mean, reading you are, but I'm assuming that nothing's changed over the weekend.
I mean, that's the one thing that, gee, it looks like we've got anarchy in France. How's that going to manifest? Well, it ended up manifesting in investment grade bond spreads and the price of insurance because we actually saw contagion, Ted. That's my point. And it's one thing to contemplate dominoes around the world, whether it's Mexico or India or South Africa or France, but the largest economies in the world happen to be in the United States of America. And if there is turmoil after the election, I think investors would be wise to not make the assumption that we're going to have one crazy night in S&P futures, and if a certain individual who once occupied the White House occupies the White House once more, that the stock market's going to be off to the races. I think that assuming lightning's going to strike twice is not the wisest way to approach this when certain tax cuts that would sunset won't. So it's over $1 trillion deficit additive on day one, and we're already paying more than $1 trillion to service that debt. And the Fed might be coming out of the gate in September and starting to lower interest rates for the first time, which will manifest as stocks losing their values. There are too many if, then, whys, and whats to connect the dots and make it as simple as if Trump wins the election, that we're off to the next leg of a stock market rally.
Yeah. Question on for you on that. When they do start lowering rates, I know this is it's almost an unfair question, but what would you see would be the point that they eventually get to? I mean, I'm just curious how your thoughts are.
So this is the hardest question to answer because we've yet to cross this great big Rubicon into a systemic moment. We had a feel last week for what systemic could look like. And I guess the scariest thing was that you ended up seeing for the first time the stress land in investment grade. And that's my greatest fear. We saw triple B downgrades from investment grade to junk. We saw an absolute explosion of that phenomenon when the pandemic first hit. So we know that because France became contagious by the end of last week, and the fact that manifested in investment grade spreads gapping out, we know that the risk continues to lie in this $3.5 trillion market. That's a big, big, big statement I've just made, because huge corporate borrowers are still huge corporate borrowers, and that's where the risk still lies. And I don't think that investors are prepared for that at all. But we do know what it looks like. You can go back and say, in March of 2020, what were downgrade volumes in triple B U.S. investment grade corporate bonds? So you can get a snapshot of it.
Well, and you talk about have you put all that together though with the Fed and the bank loans and what's going on with the individual and the workload and all that sort of thing? I don't see a silver lining there, at least on the short run. I don't. Maybe I'm.
Well, and that's the thing. And again, I sound as if I should become a spokeswoman for Bill Moreland. But it wasn't until he explained to me that it won't matter what happens, even if we go to the zero bound. And that was really his bottom line. And he walked me through some very, very simple math, if you'll indulge me 60 seconds. And that is that non-performing loans are in a numerator. And in the denominator is any given bank's loan portfolio. So if it's non-performing loans in commercial real estate, that's the numerator. The denominator is that bank's commercial real estate loans. So in an expansion, as your non-performing loans decline as a percentage of your loan portfolio, things look better and better. And lo and behold, banks actually increase their loan portfolios in such environments. And as a percentage, non-performing loans fall even further. That's great. That's what we call a virtuous feedback loop. It's when it moves in reverse and people don't go all the way through the math. When it goes in reverse, the size of the loan portfolio does not stay static. As a percentage of your loan portfolio, your non-performing loans indeed rises. But at some point on high, the board of directors or Jamie Dimon or God, somebody says at some point, you're going to have to shrink your loan portfolio. And that sets off an adverse feedback loop because then your denominator starts to shrink, even if as your non-performing loans, as a percentage of that shrinking loan portfolio takes off to the races. And that's why in a zero interest rate environment, your non-performing loan cycle goes all the way through. There's nothing we can do from here on out to stop at least 4 more quarters. In the most benign best case scenario, at least 4 more quarters of banks clamping down on lending. We don't know what the ripple through effects look like in the private sector. In non-banks, we just know that non-banks are bigger than conventional banks. So the ripple effects will be even that much worse. That's what people, even with the zero bound, I think that if there's no systemic risk unleashed, that this is going to be the longest slog of my career. If there is systemic risk unleashed, I'm just going to go hide.
And you, I don't think you think that that's commercial real estate's the only place that's going to have distress.
Oh, heavens, no. We saw what contagion looked like, and what contagion looked like ended up on corporate bond balance sheets. And that's your bigger picture. And people seem to think that because there's no sexy The Big Short movie that's showing in theaters or coming to theaters near you, that for some reason housing is Teflon in this particular cycle. What a naive thought to contemplate when you still had very movie worthy characters in South Beach that were rubbed from head to toe with oil, talking about how many condos they had purchased and what their weekly income was, going around in a circle saying cha-ching. If people think that these individuals, I call them the Airbnb jocks, didn't have leverage, they're fooling themselves. And all these all cash home purchases, if they were all truly all cash home purposes, Saudi Arabia would have and Russia would have run out of cash, but they weren't. They were leveraged buyers, and there will be major spillovers in the housing market. There might be pockets of the Midwest or maybe New Haven, Connecticut. I can name them: Philadelphia, San Francisco. There might be pockets where you won't see distress in residential, but other than that, it's coming to a neighborhood near you.
Well, and you can start to see it now for sure, all the way around. So just in closing, if you had to take a few minutes and just give some words of advice to the average investor in the time we're in right now, how would you lay that out to them?
Well, I would say that you're only safest in companies where there's not even a contemplation of a dividend being cut. You have to have a cushion if you're going to own stocks. You absolutely must have, and you have to have a bulletproof cushion. Other than that, you should be very, very careful with just going with labels of it's investment grade. I don't even need to think about it. Not when that's where we've seen stress break out first, with the first whiff of contagion out of Europe and the outcome of elections that should have no bearing on the US bond market, corporate bond market. On top of that, if Jay Powell is determined to put blinders on and ignore until he can no longer ignore what's happening in the US job market, that means that you can continue to get paid for being on the sidelines and getting 5.5% on your cash and not taking that additional risk on. For heaven's sake, do not sell your gold, but be very, very, very careful. We just saw Blackstone back out of getting financing for an industrial piece of property. Be very careful with what your financial advisor tells you is recession proof. Be very careful about that.
You know, it's interesting you say that too, because we own direct securities at Oxbow. We do not own indexes or ETFs per se, but the reason we do is because we want to know exactly the risk reward of what you actually own. But I'm going to say this, asking you a question. I think so many people in the industry, though, that give advice are not necessarily have an idea of what's in that ETF or what's in that index. And so when something happens, that they don't know what they own, I guess is what I'm asking you.
And that's the real trick, especially because my friend Mike Green has demonstrated for me that there is a critical mass of humanity that is not currently putting fresh money into 401ks in America. We have a continuation of the great resignation as the baby boomers come out of the workforce, but that has always been offset to a greater degree by new entrants to the workforce, as well as not having a white collar recession go on in the background. That dynamic has been turned on its head for the first time since indexing began. We've never had retirees and an absence of new entrants to the white collar workforce be enough to see net outflows. So the security and safety of indexing for the first time in my career is not what it once was, because the flows are not assured. So you have to, more than any time at all, understand exactly. I don't care if it's a municipal bond or a dividend paying stock, you have to know exactly what you own.
Well, that's for sure. And we've listed here numerous times during this interview how to get in touch with you and use your service. My guess is, though, if somebody looking to take your service, maybe the next 2 or 3 months will be one of the most crucial times to take it. I'm just saying that from what you're telling me that you think's on the horizon. And I appreciate you giving us a glimpse of that. And today, we always appreciate you having us, because I know you're really busy. But as always, we appreciate you being here.
Well, Ted, you are absolutely correct. I have, in the space of 4 weeks, I've gone from being that crazy lady out on a limb to, oh my gosh, what's the world going to look like? It looks like she's right.
Yeah.
And so this is my moment, but that means that it's your client's moment to not be complacent with how their portfolio is designed.
Well, listen, again, I know you're busy. Thank you. And, we'll hope to have you back next year for sure.
Absolutely. Thank you for your time, Ted.
All right. Thanks. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.